All right, so we've got one more recording here. I just want to follow up with the last lecture about interest rate derivatives. And then what I'm going to have you do, I think, is maybe do one more Monte Carlo assignment, and then we'll be done because the grades are due on the 23rd, so we don't have all the time in the world. But um, last time we talked about interest rate derivatives and how they can be priced with a variation of the Black-Scholes model, which is sometimes in the literature called Black 76 after the year in which he wrote it. But it's just normally, I mean, the actual formal title is Black's model, but you often hear it referred to as Black 76. And it's very popular on Wall Street for these products. It works very well. Um, but the ironic part is that the model was originally intended for not for interest rate derivatives, but for futures options. It just so happens that it's well adaptable to the special case of European style interest rate derivatives. Now, I have a spreadsheet here, which you have a copy of. And what you're seeing here is examples of different types of interest rate derivatives. For example, we have caplets, floorlets, pair and receiver swaptions, as well as a bond option. And all of them are being priced with the Black model or Black 76. And so the details are in the slides here. Let's see what happened. I had that open right here. It is. Here it is. Okay. Um, so just a quick reminder, an interest rate derivative is a contract. Now, the ones we're looking at here are all options, but they can be futures contracts and they can be forward contracts as well. And so the point of it is that the underlying asset is either an interest rate or the price of a security like a bond, where the value depends on interest rates. Now, we went over this last time. You can find these trading quite heavily, as a matter of fact, through the different exchanges. But a lot of interest rate derivatives, the ones we'll be looking at in particular, tend to trade in the over-the-counter market because they need to be customized to the needs of the two counterparties. So, like if I'm running a business and I know that I'll need to borrow money, let's say in 3 months, uh, that's unique to my circumstances, and so I will want to go out into the market and find a counterparty who's willing to sell me a derivative, which will have a payoff if interest rates go up in the next, let's say, 90 days or whatever it is. So while some of these do trade over like let's say the Chicago Mercantile Exchange, in particular, futures always trade on exchanges. And you can see here there's a lot of volume in Eurodollar futures, Treasury bond futures, Treasury note futures. But the options that we're about to look at would normally be customized in the over-the-counter market. So these include the following four: caps, floors, collars, and swaptions. And so what are they for? Well, these are actually, what's interesting about these products is that they usually are structured as not a single option, but as a portfolio of options that mature at different points in the future. For example, a cap might actually include options that have expiration dates in the next 3, 6, 9, and 12 months. And each individual option is called a caplet. Okay, so in other words, you have four caplets within a cap in that case. The point of a cap is to hedge the risk of interest rates going up. So you can think of it as a call option on an interest rate, whereas a floor is the other way around. With a floor, you're trying to hedge the risk that interest rates will go down. So a floor can be thought of as a type of put on interest rates. And a collar is basically a combination of the two. So that what you can effectively do is not just put a cap on your borrowing cost or a floor on your interest earnings, but put them in between a range of values. Okay, so in other words, you can guarantee that, let's say, the cost of borrowing doesn't go above 8, but it also doesn't go below 6. Um, Now, the advantage of collars is that they're cheaper than either caps or floors because of the collar. You're buying one type of option and you're selling another one, so the cost is quite low, but it also is less advantageous because it's harder to take advantage. If you're worried about interest rates going up, for example, a collar sets a limit on how high the rates can go, but if rates fall below a certain point, you can't really benefit from it any further because you're committed to paying, let's say, somewhere between 6 and 8%. Um, when that happens, anything below 6%, you're still paying 6%. So we'll see how that works as we go along. So a collar would either be you buy a cap and you sell a floor, or you sell a floor, you sell a cap and you buy a floor. Okay, so the first one, the long cap and the short floor, means that you're trying to protect yourself from rising rates at a cheaper rate than a cap, but it limits the benefits that you would earn if interest rates do fall. And by the way, why is it cheaper? Because when you see a short floor like this, that means you're selling it, and that means you're collecting money from it. So in other words, if the floor has the same price as the cap, you actually this thing could be free. In fact, it's even possible that if you choose the right ones, the revenue from the short floor might exceed the cost of the long cap, and you could actually put money in your pocket when you set up this strategy. But just keep in mind that the cheaper this position is, the less advantageous it's likely to be. So you can't, there's no such thing as a free lunch on Wall Street. A cheap hedging strategy means it's less beneficial than an expensive one. So you're not getting away with anything when you set up a collar, because it's cheaper, but you also are limiting the advantages of it compared to simply buying the cap in the first place, or in the second case, buying the floor. So anyway, the short cap and long floor, the second example, this is the one where you're protecting yourself from falling rates. But again, there's a limit to how much of a benefit you can obtain if rates go up instead. All right, so let's start at the beginning with caps. A cap is a portfolio. Typically, it has at least two caplets in it. And the reason for that is because in many cases, an organization may be exposed to interest rate risk on a recurring basis. Okay, not just once, but maybe every 3 months or every 6 months. So it makes sense to protect yourself from that risk as far ahead as you can. So you might need, let's say, protection every 3 months for the next year. And then you would set up a cap, which consists of these individual caplets. So now what'll happen is the way these are structured, a 1 year cap actually only has three caplets in it. It doesn't sound right, does it? Each with a maturity of 3 months, because the 3 month rate today is already observable and there's no need to hedge it. It's the next three that we're worried about. Okay, in other words, unfortunately, I'm not in my normal place right now, and I don't have my drawing tools here. So I will do what I can. So let's see what I can do. This is going to have to be done with the mouse, which is terribly awkward for drawing. So the times would be 0 is today. Oops. And then we've got 3 months from now, which I want to call 0.25. 0.5 would be 6 months from now. And then let's say this is 0.75, 9 months from now. And then this last one is 1 for 1 year. So in other words, if I'm being exposed to interest rate risk, let's say I'm worried about interest rates going up. For some reason, I have to, let's say, roll over a line of credit with a bank every 3 months. The thing that concerns me is that I do not want the rates to go up. So when I buy a caplet like this, what I'm actually doing is buying a caplet that starts here and matures here. Then one that starts here matures here. And then one that starts here and matures here. I don't need any protection in this for this first bucket, as it's called, because I already know what their 3 month rate is at time t equals 0. So there's nothing I can do about it, basically. But it's the next three that I'm concerned about. Because when I pay the interest, what will typically happen is the rate that I'll pay at time t equals 0.5 is actually determined at time t equals 0.25. So the rates are typically paid 3 months after the fact. So if whatever rate, let's say here, the rate that I'm paying is 6%. It means at time t equals 0.5, that's how much I'm gonna have to pay for my loan. And then let's say this one is 5. I'll have to pay that amount at time t equals 0.75. And then here, let's say it's 4. That's how much I'll pay at time t equals 1. Okay, so the rates are determined 3 months ahead of time. And then, so that's what I'm trying to hedge from today's perspective. So think of this as capital 1, 2, and 3. Now, each one of these can have a different strike. Actually, by the way, let me mention this interesting point. Unlike the call option on the stock, where we have a strike price, which is the price at which we can lock in the purchase of the stock, here we have what's called a strike rate. So let's say here the strike rate is 4%. That is the maximum rate I can pay for my borrowing. So at this point in time, I'm going to get a payoff of 2%. Okay. At this time, my payoff will be 1%. So there's what's actually happening here is that I'm actually paying the full amount, like whatever rate I'm showing here, that's how much I'm actually paying to borrow. But then I get this payoff from my option that reduces the cost to 4%. Now, in the last case, at 4% or anything below that, my payoff will be 0 because that's the strike rate. Okay. So the beauty of this is that if the rate goes down to 3, I can still borrow at 3 and not exercise the caplet, I should say. So it's just like a call option, except that instead of the underlying security being a stock or something like that, it's an interest rate. So this is, and again, keep in mind, this is the case where I'm worried about rates going up. If I'm worried about rates going down, then the payoffs would work backwards, where I benefit from the price, the rate falling, just like a put. Okay, so this is a cap, which means it's equivalent to a call on the rate of interest that I'm borrowing. And then these are the so-called caplets. Now, each caplet can be priced with the Black's model. And so the cap value is equal to the sum of the individual caplet values. So when you do something like this, you're actually pricing multiple options at once and then adding them together. All right, so hopefully that makes it clearer what exactly is going on with these caps and caplets. Oh, well, I already had a diagram right here for that. So here, oh, okay, this is good. We have some very specific examples here. The rate that you're paying is the 3-month rate at whatever time you're observing it. And so the caplet 1, the payoff is the difference, the maximum R3 minus RX, which is our strike rate, and 0, just like I showed you. Okay, so we already understand how this works. Good. And so the payoff to a caplet can be defined in the following way. Now, I do want to mention one thing, because these are interest rates, we have to know the dollar amount that is going to be paid to us. So what we have to do is 2 things. We take the payoff, which is a percent, and then we scale it by the fraction of a year. Like here, for example, since these are quarterly payments, this 2% will actually be divided by 4 because this only actually covers 3 months. So I'm actually only going to get 0.5%, but on an annual basis, that would be 2%. So this delta is the fraction of a year that the caplet is covering. The Q is the dollar amount that's being hedged. So in other words, let's say I regularly need to borrow $1 million. Q would be $1 million. So come up with your actual payoff for this first caplet. It's going to be a quarter of 2%, 0.5% times $1 million, which is $50,000. That's right, isn't it? All right, let me double check that. 0.5% of $1 million. Some things you just shouldn't do in your head, you know. See, I was wrong. It's 5,000. Okay, so that would be our actual payoff there, $5,000, based on $1 million principal, which is Q, And the fact that this is a quarterly caplet, which means that interest rate is divided by 4. So my payoff is actually 0.5% times $1,000,000, which is $5,000. Now, the beauty of these caps, of course, is that my payoff is always either zero or positive. It can't go the other way. I can't find myself paying to the counterparty because in the months or the quarters where rates drop, I may not exercise it at all. Okay. Now, often now, remember we had this discussion about LIBOR last time. That would have been replaced with some other appropriate rate, like, remember for the United States, let's just quickly remind ourselves, you have, I don't know why my laptop lately, it has been defaulting to Yahoo, which I think is a terrible search engine. SOFR for the United States. You would use that for transactions in dollars instead of LIBOR because we know that it's safer and there's a lot less potential for fraud involved. Thanks to those crooks at Barclays, this became necessary a few years ago. But the rate of interest that we are basing all this on is often a function of SOFR or LIBOR. So in other words, the 6% here, let's say, that we use as our example, it may be the SOFR rate. It's often set up that way. The strike rate is a constant, of course, but this part, this is the float, this is the rate that resets every 3 months. This one, it would typically be based on SOFR. Okay, so we look in the Wall Street Journal, we see SOFR went up to 6%. That means we are going to get a payoff. Okay, in this case, $5,000. So that would be this number. Now, it doesn't have to work like that. I mean, these are over-the-counter products. We can negotiate anything we want. This could be the Fed funds rate, but it could even be the Treasury bill yield. It's likely to be something with a very short maturity to match up with the 3 months here. You don't want to be using long-term rates in a case like this because the two are not necessarily perfectly correlated with each other. So SOFR it is. Although the slides still say LIBOR, I'll have to change those. I'll add a little postscript. They'll say, by the way, did you know about the scandal? Well, here's what happened. And then when you multiply it out, you'll see, like I was just saying, for the quarterly caplets, you have to multiply the difference between the rates by a quarter or divide by 4, and then by the principal of $1,000,000 to come up with the payoff. Okay. So the question is then, how much do we pay for this caplet? But before we consider that, we're going to go on and discuss floorlets. Now, the only real difference here is that with the floorlets, here with the cap, the payoff, oh, I'm so used to using my tablet, but I don't have it here. Okay, so with a cap, payoffs are max, R minus RX, 0. With a floor, the payoffs are exactly what you'd expect from a put, RX minus R, 0. And that's really the only difference. It's structured the same way, and it could be quarterly, for example. We would observe the SOFR rate at the beginning of each of these periods, and then that would be used to determine the payoff. Now, the payoff, by the way, typically takes place at the end of the caplet's life. So in other words, this first caplet number 1, on this day t equals 0.25, we already know that the payoff will be $5,000. But we typically don't receive it until T equals 0.5. So we know 3 months ahead of time that we're getting a payoff of $5,000. So that's how these things are usually structured. If you wanted to take that money now, what you could do is negotiate receiving the present value of the $5,000 today. Sometimes it works that way, but the payoff itself is meant to be paid at the end of the life of the caplet, even though it's determined at the beginning of the life of the caplet. So you'll see that in the formulas. We're going to assume, by the way, that they're paid at the end of the period. But in principle, we can have whatever we want because they're over-the-counter products. Now, collar, as I showed you before, is a combination. It's a portfolio. We've got either a long cap and a short floor or vice versa. It's a combination of the two that is designed to give us some protection at a lower cost than either buying a call, a cap or a floor. So let's say, for example, a corporation wants to make sure that the borrowing costs do not go above 8, but it doesn't want to pay the price of a cap with a strike rate of 8%. What can they do? Well, they can buy a cap with a strike rate of 8, but then simultaneously sell a floor with a strike rate of 6. So that guarantees that our borrowing costs will stay between 6 and 8. So if rates suddenly start to plunge, we'll be very sorry because we could have saved a lot of money. But if rates, of course, go through the roof, well, then we'll be very happy. So I think I had a little chart here. Yeah, here it is. So just to keep track of this, here's the cappage. So we own the cap, so the payoff is positive. Actually, I'm showing these both as positive. At the end, I'll subtract. Okay. So we own the cap. So this is our payoff. We will collect that. Here's the floor. We've sold this. You notice how the payoff is the rate minus the actual market rate. The net position, the position of the collar means you add the cap that we're collecting the cap payoff, but we're paying the floor put off, the floor payoff. So the bottom line is when you add these together with the market rate, so in other words, you've got market rate, which you're actually paying. This is the protection from your options. So the net effect of it, if you notice that no matter how high the market rate goes, the payoff, the interest rate cost to us never goes above 8. But if the market rate drops, no matter how low it goes, our minimum borrowing cost is always 6. But again, this is cheaper. It could be quite a bit cheaper than simply buying the cap in the first place. So this is the trade-off. You have a cheaper way of hedging the risk. And if you're not at all convinced that rates will fall below 6, it might be a good alternative to simply buying a cap because caps can be fairly expensive. Anyway, now swaptions. Now, we didn't really talk about swaps. A swap is a structure where you trade cash flows back and forth based on some what we call a fixed rate of interest and a floating rate of interest. And these are very popular for people who are hedging risk, interest rate risk. But they also can be used for hedging currency risks. There are interest rate swaps and there are currency swaps. And currency swaps are where you trade payments in two different currencies. Whereas interest rate swaps, you're trading payments based on one hand, fixed rates, which never change, and floating rates, which change on a regular basis. And so the purpose of it is to either hedge interest rate risk or currency risk, but for an exposure that occurs on a repeating basis, not just once. So you're either, when you enter into an interest rate swap, either you are paying the fixed rate and receiving the floating rate, or the other way around. And so if you are the fixed rate payer, you're paying fixed, receiving floating, that means you expect rates to go up. You're hoping they'll go up even because that way you'll make a profit. So this position is equivalent to buying a floating rate bond and selling a fixed rate bond. Now, just as a side note, a floating rate bond, you don't see this very often. A fixed rate bond is what, the normal case. is one where the coupons are set in advance. And that's true for the vast majority of bonds. A floating rate bond is one where the coupons are periodically reset based on a market rate, such as SOFR, formerly LIBOR. Okay. So in other words, imagine a bond where you get a coupon once a year based on whatever the LIBOR rate was last year, let's say, or something like that. That would be a floating rate, but the coupons are different every year, potentially. So by having one of these swaps, what you're effectively doing is buying the floating rate bond and selling a fixed rate bond. So the net effect of it is you're paying a fixed rate and you're receiving a floating rate. And then the floating rate pair is in the opposite position. So why are we mentioning this here? Because swaps are equivalent to a portfolio of forward contracts. And we don't really have time to get too deeply into this right now, although you can read this on your own. But this little table shows you how you would determine the value of a fixed for floating rate swap at any given time. And it would be based on the term structure of interest rates in the market. And you're calculating basically the present value of the cash flows to the fixed rate bond and the floating rate bond. The difference between the two determines the value to the two counterparties. But so anyway, all that background is just to show us that there exists a product called a swaption, which is an option on a swap. Okay, so this falls now into the category of securities that can be priced with the Black's model. So either you're doing one of two things. The pair swaption means you're paying fixed. The receiver swaption means you're receiving, you're paying floating or receiving fixed. So this one will also be priced with Black's model. So anyway, with all that being said, just a quick review. This is what Black-Scholes looks like. You might recall from way, way back in the beginning of the first course. And so we need to know what is being changed here to turn it into the Black model, where the underlying is actually a futures contract, which what they're effectively doing here is they're replacing the futures contract in this model with a forward rate of interest. And that's how they fudge it to go from a futures option model to a forward an interest rate derivatives model. So what gets changed is, oh yeah, this is all reviewed, by the way, right here. Yeah, you might recall, I didn't realize there was so much review in this chapter. This is where we extend it to price options on securities other than non-dividend paying stocks by introducing this Q, which is the yield on the underlying asset. And then the form is a little different. Like here we have this new term and this term here. So here's an example, which I believe we've already done this one. But now here it comes, Black's model. What's going on with this Black's model? So S is being replaced with F. Now, originally, remember, Black was thinking in terms of futures options, so that F is meant to be a futures price. But to price interest rate derivatives, we can replace that with forward rate of interest. And then this becomes a strike rate. And so, by the way, there's a whole slew of reasons why this model should not work, but it seems to do it anyway. In other words, a lot of the assumptions the Black-Scholes are based on are not really appropriate for interest rates. And yet somehow it seems to work well. Okay, it's been used on Wall Street ever since. That tells you it must be good. But so we'll skip over this a bit and go right to the model. Yeah, I mean the thrust of this is that stocks and interest rates behave very, very differently from each other. And so a lot of the Black-Scholes assumptions are not really appropriate for interest rates, but yet somehow they found a way to make it work properly. Part of it is because we're using forward prices in the model. And so in other words, a forward, let's say you want to buy a bond that will be delivered in 6 months. The price that you will pay for it at that time is called a forward bond price. And that's what the Black-Scholes model is actually pricing. So if a bond has discrete, meaning very infrequent coupons, then you can use this model to price or calculate the forward price. B is the bond's current price. I is the present value of future coupon payments. And that can get plugged into the Black's model and give us an actual formula. So here's an example where we've got an option on a bond. It's a 6-month call option on a treasury bond that matures in 15 months. The bond pays a 5% coupon rate, and the coupon payments are made annually, and the face value is $1,000, which means that when you buy this bond, you pay $1,000, then up until the maturity date, you collect a 5% coupon until the final day of trading, at which time you receive your $1,000 back. So now this bond, on the other hand, only matures in 15 months. What that means is it was probably issued 20 some odd years ago, and it's going to mature in 15 months. So right now it has a maturity of 15 months, but it would have been issued originally with a much longer maturity, possibly 30 years. Now, what that means then is that when you go in the market to buy it, that means you're not necessarily paying the face value for it. Like if I bought it on day one, I'm going to pay the face value. At maturity, I'll receive face value, and in the meantime, I'll get a bunch of coupons. But if I'm buying the bond after it's been issued, I'm paying whatever the market price happens to be at the time. But at the maturity date, I still receive the face value. So that can have an impact on the value of this bond option that we're about to describe. So it's important to line up all the cash flows because you've got another coupon coming up in 3 months worth $50. And a year later, we'll not only get another coupon, the final coupon, but our $1,000 back. But the option on this bond matures in 6 months. So the owner of this option is going to lose the opportunity to get this $50. But if they exercise the option and buy this bond, they will collect the remaining $50 and $1,000. So let's say that at the moment the market price is 1,020, and that is more than 1,000. That means that rates have fallen since this bond was first issued. If rates had gone up, the price would be below $1,000. Now, also we have to pay attention to the fact that interest rates of different maturities will typically be very different from each other, or at least different. They don't have to be very different. So we're assuming that the 3-month rate of risk-free rate of interest, meaning the yield on a 3-month treasury bill is 2.5% per year. Keep in mind, these are always annual rates. And then the 6-month rate, meaning the yield on a 6-month treasury bill, is 3% on an annual basis. But we're assuming that these are compounded continuously. It's just easier mathematically to do it this way within a derivatives model. In practice, we don't see continuous compounding as we've discussed, but Hall's book loves to use continuous compounding. And here it makes sense because the Black-Scholes model itself uses continuous compounding. And of course, that in turn means that we're assuming that the interest rates are paid on a continuous basis or at every instant in time. So that makes the model a little bit easier to develop. And so first, we're going to do is figure out the present value of that coupon that we're entitled to in 3 months. But if you notice, we're using E raised to the minus, this is the time period, and this is the interest, this is the interest rate. This is the time period. So that means having $49.68.85 now is equivalent to getting $50 in 3 months. Okay, when the 3-month rate of interest is 2.5%. So that tells me, based on this model, that I should expect to pay for delivery in 6 months for this bond 984.9759. Okay. And the reason why it's lower than 1,000 is because I'm not going to get the opportunity to collect the final coupon. So now we're also making some more assumptions. The volatility of this rate of interest that we're hedging is 10% per year. This is a 6-month option. The strike is assumed to be $1,000. The risk-free rate is 3% in 6 months. The current market price is 984, or at least, I'm sorry, the forward price is 984.97.59. So I plug these in, and so what this means then is that the call has a price of about $20. And you can see it's very much like the Black-Scholes model, except really the complication that here we need to figure out a forward bond price. So this is how you would price a bond option. And in fact, I think that exact same example is over here. Yeah, that's the one. Okay. So in other words, now, by the way, all of this information is in the code, although it appears in the spreadsheet. If you go look in developer, you'll see. Now, by the way, the code is listed here under modules. Now, this one has quite a few of them. Usually, so far, every time we had a spreadsheet, there was a single program in it. But if there's more than one, they need to be organized. And so over here, you'll see black bond option. Now, the actual code is pretty straightforward. All you're really doing is taking this formula, this Black-Scholes formula, which we've seen before, and we're feeding into it the constants that we need, which is quite a bit. I mean, you can see here, we need all this information. Wow. To do our proper job. But once we do that, see, it's only calculating the Black-Scholes components. It's we have to do all the rest of this ourselves. But once they're in place, then you are, oh, I see. No, it's doing D1 and D2 and D1 and D2, but oh, it's actually doing the forward price as well. So at least, yeah, okay. So it's doing some of the work. But we have to provide it with an awful lot of information, as you can see. So when we're done, here's the final result. This is the price right here, $20.80.402. And just like we've seen before, if you wanted to check the assumptions, if you want to see what happens if, for example, I change the strike price to 1,050, you can just go ahead and type that there and run it again, and you'll see the answer will pop out. Now, this one, to be perfectly honest, this one could have been written as a single I mean, we could have done this right on the spreadsheet. We didn't really need VBA for this one. There's nothing in here that couldn't have been done directly in Excel. We don't have any loops, let's say. So, but this way, at least you get to see how the VBA looks. And yeah, I mean, if you wanted to take a shot at that, you could create some Excel code or functions, and you'd see that you'll get the right answer. So then this is how you would calculate caplets. The only thing that's different here is this present value term. It's hard to tell what this is referring to, but this is the present value. So for example, if remember I told you that the payoffs occur in the future. Like here, for example, the rate is determined at time t equals 0.25, but the payoff is determined at 0.5. So the payoff we're getting, if we wait 3 months, we'll get $5,000, right? From before, but the payoff today would be equal to the present value of that payoff. So the model is going to be based on present values. So that means that we need to know the present values of these payoffs to come up with the value of each caplet, which then in turn will give us the total price of the cap, So that's why this is here. This is Z0T plus one. It means the present value of until the payment is actually received. That's the only really new piece here. We have, again, the delta. These deltas, by the way, are usually the same. In other words, you wouldn't normally have like a cap with caplets of 1, 2, 5, 8, 10 months. They're normally all the same, like 3, 6, 9, 12 months, that kind of thing. But it's possible that they could be different. So that's why it's delta with the subscript I. And of course, Q is the principal that we're hedging. So you can see this is a pretty straightforward model. But you do have to have all this information about the term structure of interest rates. And also, if you notice, we need LIBOR at the different points in time. We need a forward rate that covers the time between the payments. There should be a formula in here somewhere for that. Actually, I think the code takes care of that. But the bottom line is this. The way it works with this is, and by the way, this is one of the great things about continuously compounded rates. It's easy to calculate forward rates because it's essentially a weighted average of the spot rates, weighted by the time at which they're received. So, like this one, you would have, and since these are fractions of a year, what you would actually be doing is taking 0.5 times this rate plus 0.25 times this rate, add them up and divide by the time that elapses between these two. Okay. What would that equal? So 0.5 plus, or minus rather. No, sorry, it's plus, yeah. Because it's an average. Oh wait, sorry, that one's 2.5. All that would be divided by. All right, let me just quickly double check that. No, I think I was right the first time. There would be minus here. All right, one more time. Yeah, that's right. So this is how you would calculate that this forward LIBOR rate is the rate that applies between months 3 and 6. That's why it's called a forward rate. These start today. This one tells me if I want to borrow at LIBOR today for 6 months, I'll pay 525. This tells me if I want to borrow just between months 3 and 6, it'll cost me 5.5. That's how you interpret these. These are in between, like 5.5 applies here only. 6.0 applies between months 6 and 9. And this one applies between months 9 and 12. These start today and they mature at these dates. Okay, so these are spot rates. because they start today. These are forward rates because they start at some point in the future. A lot of derivatives models are based on forward rates because cash flows take place in the future. So here we have a method for calculating. And by the way, the naming conventions can be a little strange. This rate that I just calculated for you is called the 3-month forward rate. 3 months forward. I mean, it's a 3-month rate that starts in 3 months, a rate that applies between months 3 and 6. And so here's what we've done. Okay. So we've got a weighted average in the numerator of the two rates, and then the difference in the times in the denominator, and that's your forward rate. That's the number that the model is based on, by the way. If you look carefully at the Black-Scholes, the model, you don't see any spot rates in here except for discounting purposes. It's all based on forward rates right there. You see, but and again, that comes back to the fact that Black's model was originally meant for futures options. So we've replaced futures prices with forward rates of interest to make this model work for interest rate options. So whoever came up with this idea, I don't know if anyone knows whose idea it was. It wasn't Fisher Black. This was not his idea. Somebody figured out on Wall Street that we could apply these to interest rate options, and that made the market explode because suddenly it became possible to price them correctly. So anyway, you'll see that then it would be a very simple matter to adapt this for floors rather. Okay. And then collars are easy because you just have a portfolio of you're buying one and selling the other. The swaptions are a little bit trickier because of the repeated cash flows. So we sadly won't have time to go over that today. But anyway, so I think we're going to have to stop here, not just for today, but for the course. But I will look at your code and see what the issue was. I'm sure it's some little thing. I'll fix it for you. And then I'll give you another Monte Carlo, which is somewhat different than what I gave you. And it only needs to be adapted a little bit to price something different, like one of those very bizarre exotic options. You might find that to be very interesting. So I looked up on the schedule, and the grades are due on the 23rd. So I'll let you know exactly what you're supposed to do next in the next day or so. And then I'll have you send me like 2 programs, basically, the one you just did and the new one. And that will have to do it for your grade, which I'm sure will be very good. But, under these circumstances, we had so much fun with the notes that giving out tests or assignments didn't seem to be such a big deal. But, we do need to have them to give you a proper grade. So for now, this will be enough. But probably tomorrow, I will be able to send you your corrected code and just instructions for the next and final assignment, which will be a Monte Carlo for one of the exotic options that we're looking at. So it will only require minimal changes. So, all right. Anyway, so I hope you had fun this semester. This is very challenging doing this online, I know, but and we don't offer this course very often. But it's fun for me too. And obviously you can tell I find these concepts very interesting, and so hopefully you've had a good time too. So I'm going to sign off now, and I'll send you this along with this document that I've been working on. It's somewhat helpful. I'll send it to you anyway, and then I'll let you know what to do about the final project. Okay. All right. So I'll see you later. Bye.